Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Hello, and welcome to the Second Bite Podcast. My name's Todd Taskey. I am your host, and we are starting a new series called the PE Insight Series, where we interview, I think we've got 8 private equity executives of all different flavors, all different size of funds, different experience in the space. And they talk about many different topics. I asked them 5 questions in this series. Today's question is first impressions. And first impressions in this space are almost always driven from a deck or a SIM, a confidential investment memorandum. And it's from this material that private equity guys and all buyers really make their initial assessment. So my question was, what drives that for you? And I think what you'll notice here is a couple of constant themes, which is be simple, be direct, tell me what is really going on here and tell me the approximate size of the business right from the beginning, and then I'll dig in more as I need to. But then there's a whole bunch of different flavors based on the investor, based on what they're looking for, based on their criteria. We talk about that in some of the later questions, but I think you'll enjoy this. So I ask each of the participants what drives their first impressions, what they look for in a deck, what they like about one, what they don't. I think you'll enjoy this episode. We're going to go through that question rapid fire. We'll go through those answers rapid fire with our guests. And I want to thank our sponsor at Fiscal Advocate. The folks at Fiscal Advocate are really great at helping agency owners and founders create a dashboard around their financials so they can make good financial decisions based on what's really going on financially within their agency. So Fiscal Advocate, you can check them in the show notes. You can find them online. I hope you enjoy this episode. Casey Swercheck from Alterna Capital. Question number 1 is first impressions. I'm curious, roughly, because you're a good sized firm, how many decks do you guys get each week?
Yep.
And how do you personally process? What do you look for first? What pisses you off? What do you get excited about? What informs your decision about taking a next step?
Sure, absolutely. So the good news for us is we've been around for about 3 years, even though the principals have spent their career lower middle market private equity. And so we've got a lot of our networks established for where we see deal flow from. And it's actually been an upward trend in terms of number of deals reviewed on a weekly, monthly basis. So we're averaging today about 80 to 100 deals a month that we're typically seeing. I would say, for us, about half of those are coming in without a process, and when I say a process, I mean some intermediated fashion. So an investment bank, a broker, or whatever that is sending the deal over to our desk. And so that's about half of what we see comes through those types of processes. The other half comes in completely organic through people in our network, direct from business owners, from service providers, et cetera. And so, we tend to get through, I'd say maybe 40 to 50% of that as far as actually spending the time digging in, getting materials, and the other, 50 to 60%, unfortunately, ends up being desk kills. It's just the wrong size for us, the wrong industry, the wrong deal dynamic. It's a sector we have absolutely no expertise in. And so we know very quickly how to right size whether or not it's something that's truly actionable. And at the end of the day, decision-making here goes through the 3 partners that are on investment committee. And effectively, we know what our hot buttons are. We know what's not going to, we need unanimous support in order to move forward on investments. So anyway, all of those filters, size, industry, experience, kind of, hot button issues, bad experiences in the past, that helps push everything through that funnel pretty quickly where we down select.
One question that jumped to mind, Casey. What do you notice as the biggest difference between a deck that comes from a banker versus one that just comes from the principal?
If there is a deck that comes from the principal directly, more often than not, it takes a lot longer. I think that's the biggest difference that you're signing up for and going into a proprietary deal or off-market deal. is that the financials are not going to be, buttoned up in a nice format that, you put everything through that you work on, Todd, right? It's going to be in varying formats, exporting raw data out of QuickBooks. Then there's a lot of work doing that assembly, that packaging of information so we can digest it on our side of the table.
Yeah.
So
and you guys have to do all that work on your side then.
Yeah, that's right. So it takes a lot longer. Good news is, we've got a full team that can get through that, get up to speed pretty quickly. At the end of the day, for us, the first, second, and third most important point is the entrepreneur. It's the founder, right? It's that partnership angle, and is that somebody we can work with for that next bite at the apple. So we're forming that rapport and that relationship first versus starting with the data and then trying to form an opinion of the operator.
Excellent. That's super helpful. Casey Swercheck, thank you for your feedback. Josh Bilmes from Oceans Equity. I want to talk to you about decks, which are or investment memorandums or SIMs, which are an important part of our business. How many decks do you see on a weekly basis? And more importantly, if you were in charge of decks, you can never do this and you always have to do that. What would your requirements be?
Sure. We see a lot of them. Oceans Equity is, recently started, but even in the first few months, we're seeing probably close to 100 a month. So I don't know, 25, 30 per week.
Wow.
So there's a lot of information to digest. We've gotten pretty good at parsing through it and developing an eye for what's authentic, what's real and says, hey, this is a fair and balanced view on the business, versus what's just a marketing pitch. Right, which typically can come off as very superficial, and no one assumes that every business opportunity is simply perfect, right? So, personal preference is when I'm reviewing these decks, I'm looking for a fair and balanced view. Say, hey, this is what we do really well, but we know that this challenge exists, and this is perhaps an opportunity or something that we'll have to proactively attack. But when you embrace some of those imperfections up front, it really can inform the conversation. You feel like sellers and their advisors are being very forthright, and it can kind of shape the conversation of how can we fix these things? How do we improve this business and take what's perhaps imperfect, improve upon it, and then grow it from there. So really create the.
It shows a big self-awareness, I assume, and also would explain why I'm looking to do a transaction. Is that fair?
For sure. You want to get a sense of why and how they got to where they are and why now, and really try to understand a bit more about some of the people behind the business, because oftentimes that's the most important thing.
When you review a deck, do you review it in order or do you jump around?
I typically do a page turn. Usually there's a reason why it was assembled that way. And so I typically will rely on the creator for, having some rationale behind it. And then you refer back to it from time to time as you need to refresh. What was this? What was that? You typically go back and find what you need.
Excellent. Josh Bilmes from Oceans Equity. Thank you. Nick Moritsugu from Imperial Capital. I'm super happy that you could be with us. I wanted to get your thoughts on what your first impressions are like when you review a deck. So a couple questions would be, how many decks a week do you yourself and then the firm get? And what captures your attention first? And if there was a rule, if you were in charge of making decks and you could say this has to be in every deck and this can't be in any deck, what kind of feedback would you give for entrepreneurs to be successful when they put a deck together?
Yeah, no, great questions, Todd, and really appreciate you inviting me on and happy to be here. I'll answer them in order. So yeah, we generally will look at somewhere in the realm of 2 to 3 SIMs or presentations per week. But I would say, unlike some other private equity firms, and forgive me for giving the 30 seconds on our background, but we do a lot of industry first research and analysis before we actually go deep on any specific companies. So there's a lot of situations where we're actually looking at deals on a proprietary basis, where the founders have prepared either some sort of summary or even some high level financials as opposed to a fully baked SIM or presentation. So we're often used to starting with something that's even less built out or complex or sophisticated as a full-on presentation. But we do look in particular in industries where we've developed a thesis and developed a view at brokered processes. So I spent a lot of time reading these sims in the past. In terms of what captures my attention first, I would say, over years of investing, you start to apply some filters, right? So I would say, we first look at size. What's the total revenue? What's the total EBITDA of the business? We spend a lot of time thinking about service mix, right? So what are the different sources of revenue? How does it split effectively? How do you make money? What is the revenue quality of those different forms of service mix? Meaning, how recurring is it? How reoccurring is it? How episodic is it? And often, and frankly, I'm guilty of this. I'll often skip down to the historical financial section of the presentation before I go through all of the, call it investment thesis highlights, just to get a sense for, hey, what has the financial performance been? Is it kind of penciling out? And then to answer the last part of your question, I would say the one rule I would enforce would be just giving a full picture, or as full a picture as possible, of financial performance. And what would be included in that? I would say, you want a few years of history and ideally a forward-looking view of the business as well. But it's also about being open about some of the items that are in those numbers, right? So if there are EBITDA adjustments, just being upfront about what the adjustments look like, I think is very helpful for people. Because the last thing you want to do generally is paint a picture that after a little bit of scratching or digging or diligence starts to kind of, separate out from what was originally put in the summary. So I like to say it like, hey, just be transparent, show the information up front. And personally, I think that goes even further down to include stuff like ideally a bit of a view on working capital dynamics of the business, the CapEx profile of the business. Because for us in our seat as investors, it allows us to put all of that financial information together and kind of put it through a model or put it through some analysis to figure out, hey, ultimately the exercise that we're trying to go through is, is this a business that I want to potentially spend more time with, invest in? And then also, what is that business actually worth, right? And so having all of those variables and that information, I think is very helpful for us when we're forming that initial view. Because if you have to ask for it over and over and kind of dig 3-4 levels deeper, sometimes it's a less efficient way to go about it.
Nick Moritsugu, thank you so much from Imperial Capital for sharing your insights. Bill Sommerschield from Keystone Equity. First impressions. You get, I've got just a couple of questions in here for you, but you get roughly how many, to put it in perspective, how many decks a week? When you get a deck, what captures your attention most quickly? And what are the things that you've become trained to look for when you get a deck?
Yeah, no, it's a good question. Look, we keep pretty good stats. I'd say we probably get 1,000, decks a year. We do a lot of, proprietary sourcing directly with founders. So that's a big part of how we source too. But yeah, we probably get 1,000 a year, 20 or so a week that we're sifting through. As it relates to what captures your attention, I mean, honestly, I think first and foremost, it's can you understand what they do? I think, way too often you get something where it's just full of buzzwords. They haven't simplified, how they're explaining the business. You can even understand what they do, even in an industry well. So I'd say that's probably first and foremost. And I think, for us, I think there's a few, pretty key threshold issues that we try to knock down early. One is just financial performance consistency. Again, it's not like everything has to have a perfect trajectory and grow 10, 20% a year, but are there big jumps? Are there big swings in growth or profitability? Do they have a future that they're saying they're going to achieve that doesn't, remotely match, current reality, right? And so those are pretty big ones out of the gates. For us, because we do tend to be longer term partners with our management partners and tend to work with entrepreneur-led businesses, that, we want to make sure that that relationship is solid. The team quality and the depth is another thing we flip to pretty quickly. And then again, being professional services business and having those client relationships as critical as they are, and that visibility into where those relationships lie within an organization, all the dynamics around who the clients are, how stable and predictable they've been historically, what the opportunity is with them going forward. Like those are all probably some of the key things that we look for right out of the gates.
Excellent. Thank you for that. And if you were in charge of sims or decks, and you could outlaw one thing in every deck or require one thing in every deck, what would that be?
Yeah, I mean, I think the first piece is just the simplicity of how you explain the business. It is surprising to me how hard that is, for people to get on paper.
And you want that right up front, I assume.
I just think you've got to start there. You can get into the complexities of the business and, in tech services and some of the other professional services areas that we spend time in, they are complex business models. There's multiple ways that you sell. There's multiple ways you deliver different types of revenue, right? And contracting and all that. And that's fine. But you need to be able to, kind of the old adage of you got to be able to explain it to a kindergartner, right? And I think you do yourself a favor by making sure that executive summary is simple, is succinct, and clearly allows people to come away with understanding the value proposition and what you drive for your customers and why that's differentiated in whatever your market is. Look, I think the other is own the flaws. And I think there's a balance. I understand, some of that takes a voiceover, but if there's just massive, customer concentration, or it's really underinvested in, there isn't much SG&A, you're never going to hide that. And so, it's really, you can, if you own the flaws and you kind of talk about what you're doing to mitigate them or where the opportunity is with a partner, you're going to have a lot more success than if you try to hide them, because at the end of the day, a good investor is going to spend the time to really dig in and they're going to find it. And, you can instill a lot of confidence if you own it up front and talk about what you're doing about it.
Excellent. Bill Sommerschield, thank you so much. Trenton Sisson from Mountain Gate Capital. Trent, happy to have you participating with us. And I wanted to ask from the very beginning, so Mountain Gate Capital has built a tremendous reputation, particularly in the digital marketing space. And I would imagine you get a lot of decks, right? Or information memorandums, whatever we want to call them. My question to you is, number one, how many do you get weekly or monthly? And then number two, what do you most immediately focus on? And number three, if you were in charge of all decks going forward, what one or two rules would you implement to make the whole process more effective?
Yeah, great question. So I think starting off, maybe at the firm level, we get about 1,000 books per year. And of those, we probably sign an NDA and do a deeper dive into about 500. And then of those 500, we probably have some, expressed interest, indication of interest, advanced conversations on maybe 100. And then of that, we probably close somewhere between 5 and 10 deals a year. And so
wow.
In a sense, to your point, there's a lot of deals that come in. It turns out to be kind of several per week that we're reviewing, each of us individually. And so, look, as you know, that means that you have to screen these pretty carefully. And so really what we're looking for is a profile of a company that matches our thesis. So we at Mountain Gate specifically focus on 4 major sectors. And so we're looking for companies that fit into one of those sectors or verticals. It's generally B2B services companies or specialty manufacturing, specialty distribution. We love the marketing services space, as you mentioned. And so we're looking for somebody that generally is in the one of the sectors that we have an expertise in a vertical in, and the right kind of size profile of company. We're looking for kind of high level benchmarks of profitability, growth rate, things like that would kind of align with what we've seen or experienced in terms of, averages that companies have over time. And then, look, to your second half of your question about like one rule, honestly, the single biggest rule that I would say to everybody would be clarity of what your business is today, what you really do, how you guys do it. I think it's very easy to try to, people try to dress up their business a lot. And so you see a lot of buzzwords or, kind of corporate jargon in there that makes it really hard to diagnose or digest what a company actually does, And so I think maybe that enforcing some level of like strict clarity on how you're coming to market, because people love the type of business that you've built, right? And there's especially if you're working with a good partner or advisor like yourself that is going to send this to the right parties. Those parties are looking for exactly your type of business, and you don't need to, dress it up in any real way. You can just, be who you are, and we can react from there.
And I think it's fair to say if you dress it up or describe it as something other than it is, that will get discovered a few weeks or months, but tens of thousands of dollars later, and you won't get to close fooling anybody. Is that fair to say?
Yeah, I think that's a great point in terms of getting to a closed deal. I mean, but even just when we get initial sims in, it can be a killer from having somebody review your deal right out of the gate. So yeah, everything you said is correct. But I mean, even just up front, when you're getting a teaser or a lead on somebody, and they describe themselves as a digital transformation, digital first, bespoke boutique, AI driven services company, you just kind of sit there and you go, okay, so wait, what do you do? Nothing in there described at all what you actually, service you provide to a client. So
so get to the point quickly.
Yeah, even just that makes you kind of pause and go, I understand what this actually is.
Trenton Sisson from Mountain Gate Capital. Thanks for your input.
Yeah, thank you.
Brian Schmidt from Court Square. I want to ask you about first impressions and a couple of questions. Number one, you get a lot of decks throughout the course of the year. Give me a rough idea on maybe how many decks you get, and then what captures your attention. And if you were in charge of decks and there was one rule that you could never put in or you always have to have, what would that be like?
Yeah, great questions, Todd. Look forward to being on today here. So we get a lot of decks. Every week we probably get 5 to 10 for portfolio add-ons, and then we probably get another 5 for true platform opportunities, and that's just in sectors I spend time in. So across the firm, you can multiply that probably by 8.
Wow. So you're getting a couple thousand.
Yeah, in the thousands, certainly. And that's been backed up by the legal bills to turn all these NDAs. So I could get you an exact amount, but I'll just say it's a lot. And that kind of leads into your second question, which is, if there's one rule I could enforce on every deck, it would candidly just be the principle of simplicity. So, one, distilling complex ideas into clear and straightforward language, avoiding unnecessary jargon or verbosity, right? So just focus on delivering the key message efficiently in the deck, and clarity and brevity, right? So make the content easy to understand. This is going to help people like me and investors across the board. It's going to maintain our attention, our engagement. I mean, you'd be shocked at the amount of decks that we see that never end up describing fundamentally what a business does. I have to go to the website a lot of times to figure out what a business does, and then that's not even clear, right? So how does a business make money? What are the unit economics of $1 revenue generated? Why does that business have the right to win? Why is it special? And then the last thing I'll say is just avoid repetitive material on a deck. And then as for where my eyes go, it's great to have a cover company overview page. And then I'm flipping to the back typically to just check out financial trends. So those are the two things I'll look at very quickly.
So let's repeat that. You're going to look at the first page or two. You're going to jump to the back to see if the economics make sense.
Right.
And then you'll decide if you have interest. Because I guess if you think about it, if you're reviewing, 20 decks every week or 80, I mean, you've got to be efficient with it, right?
Yeah, I think time is the one thing that is a governor on all our investors' success here, right? So you need to be efficient with your time and how you spend it, and you need to get to an answer pretty quickly. And I would tell you that by going through that exercise of looking at the first couple pages, looking at the back and the financials, you can come to a conclusion pretty quickly if something is or isn't a fit for a portfolio add-on or for a platform deal.
Excellent. Brian Schmidt from Court Square, thank you. All right, Bill Dyer from Boathouse Capital. You have been in the business for a long time. You provide both equity and debt for entrepreneurs. Question to you is, how many decks do you see each week, just to kind of put it in perspective? And perhaps more important than that, if you were in charge of decks and you made up the rules for the industry, what would you require be in every deck? And what would you eliminate and would not allow in decks going forward?
Wow, that's an interesting question. So on average, in a given year, we see around 1,200 deals. So if you break that down by the week, that's, 2.5 a week, something like that.
Yeah.
So it's a lot. Now we have, several deal leaders here. So I'm not seeing that many. personally, but yeah, we see it. We see a lot of decks, and the truth is that, and we close 5 deals a year or something like that. So if you do that math, I can't do that math. It's a very small close ratio, but you start with the 1,200 and probably at least half, if not 75%, just get thrown out immediately just because they don't fit. It's too big, too small, too something, whatever. But
you find that on those decks, Bill, do they do a good job describing that right up front, or do you have to hunt around a little bit to get to that?
And so, yeah, that's what I was going to suggest. Sometimes they do not, where you really have to dig around and figure out, okay, what does this company actually do? And one thing that you never see anymore, you used to see, 10, 15 years ago is in the first sentence of every deck was so-and-so company located in so-and-so place. Now it seems like really hard to figure out, like, where the heck is the business located? And, that's the same with the websites nowadays. Like, you go to contact and it never gives you, where the location is,
Right.
I guess in the virtual world. But, I'd say that, what is certainly helpful to the reader is very upfront on the first page, just a very easily understood executive summary as to here's what the company actually does, without all the puffery of what, of what maybe the company aspires to be, or, industry lingo that can be confusing. Just, here's where it is, here's what it does, here's how many people work at it, and some basic financials, right up front. And then very quickly you can assess, okay, this is something that I should read more about, and I'm happy to dig into the puffery at that point. Or maybe it's just not a fit, or maybe it's a fit for one of our portfolio companies or some other person in the industry I may know. But I think by and large, most decks, their executive summary can often be confusing with a lot of industry lingo that leads the reader to either put it down and maybe I'll read it later today or some other day, or maybe dig in further and be understood, or maybe never read it,
Right.
So that's where the investment bankers often have to call and explain, like, all right, I read the book, what the hell does this company actually do?
And you shouldn't have to do that, right?
You should be able to do that. I mean,
Right.
it's not that hard. Like, if it's something
really
that's
not.
super technical, it's not going to be a fit for us anyway. So, and then we're not going to get those calls. So yes, I would say that the investment bankers could save themselves a lot of time and a lot of phone calls if the decks were just a lot clearer. And they can still be salesy as they should be and whatnot, but they don't have to be confusing.
Got it. Bill Dyer, thank you for your input. John Findlay from Periscope. I want to talk about first impressions. Give me an idea, roughly, how many decks do you get during a week? How do you review those? What do you really look for? And if you were in charge of decks, what would you require either be in or out of everything you see?
Yeah, it's a great question. I think from a volume perspective, as we look at pure play platform opportunities, we're looking at over 400 deals per year. And these are deals that fit our criteria. These are deals where we're conducting what we call SIM reviews internally here, which is a very specific framework that we've developed over many years that helps us evaluate opportunities on a weekly basis.
Somebody else does that before it gets to you?
Yeah. So, we have a process that we follow when deals come in, either through deal leads, partners, or our BD leader here. And, depending on whether it's a platform opportunity or a add-on acquisition, we staff it and we follow that framework to really make sure that we're evaluating that opportunity across key criteria that's important to us. There's obviously financial criteria. We look at customer diversification and retention, and obviously growth and addressable market size is really important. But we spend a lot of time just trying to figure out in layman's terms, what does the business do? I think as I think about what is one rule I would enforce it would probably be that. It would be try to simplify how you describe businesses or your positioning in the marketplace. Eliminate the buzzwords that some people think are going to get them extra premium in their business when they go out to market. If you can simplify that messaging and accurately portray where your business sits within the marketplace, you're going to be set up for success. If you try to position your business in an area of the marketplace that does not align with the data and with the value prop, that's where things can go sideways, frankly. And that's where we spend a lot of time assessing these opportunities. And I think a challenge for us can be if there isn't credible or organized data to kind of back up those assertions, it can take longer to get through our process. But as I think about, hey, what are the really important rules that would make our assessment evaluation process upfront more efficient? It would be simplify the description of what the business truly does, make your audience when describing that a high score, and secondly, accurately portray where the business sits within its marketplace and against its competitive landscape.
John Findlay from Periscope Equity. That's a great and complete answer. Thank you very much. All right, I'm going to go into question 2. However, if you want to mention anything about Periscope as we talk, like an investment committee, when the fund is this big, or, this is our history, or this is why we've been successful, any little plug like that you think is helpful, we'll do.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.